Hi, everyone. Welcome back to the Twin Shores Financial YouTube channel. Today, we're going to be doing part two of three of our 401k series, where we're going to be talking about what you do when you first get your 401k and what you put into it and how you build wealth there. Today, to help us will be Tim Nihill, our founder and CEO, who's had a lot of experience in the 401k process. Tim, what do you got for us?
Awesome. Thanks, Alex. Well, hello, everyone out there. Today, we're really going to take a look at, in part one, we talked about figuring out how much money to put into your 401k, how much to start contributing, and probably more importantly, how much not to contribute and start building savings outside these 401k vehicles as a replacement to what we used to have as the broken or the three-legged stool concept, which is completely broke now and broken. So here's kind of the situation, and we're going to walk through a new client that came to us. She just got a new job. She's working her way up. She's still very young. She gets the package from HR. Hey, welcome to the company. We're excited to have you. Here's your role. Here's your objectives. Here's what you need to do on a day-to-day basis. And then here's all your benefit information, right? Healthcare, medical care, dental, vision, FSAs, HSAs, depending on high deductible plan or not. And then in that package you get the 401k information. You're like, okay, great. Where do I start from here? So this is part two. When we're going to use a live sample and a demo of, okay, I figured out how much I want to start contributing to my 401k. I figured out, do I want to do regular tax deferred or maybe Roth 401k if it's offered? Now, how do I invest, right? So our first recommendation for the people that we work with is to find out, and it's a very simple question, and you can find it online when you log into your 401k for the first time. Does my 401k plan offer a self-directed brokerage account window, right? So an SDBA is basically an open window where you have access to the full spectrum of investments which are available through that 401k platform and provider. So for the most part, it could be at least 3, 4, 5,000 mutual funds, or there are options where you have access to stocks, bonds, instruments outside of your typical 401k lineup. Now, we have people ask this question for really one of two reasons, right? First and foremost, working with us, we can help people better manage their 401ks. That's just a simple fact. We're not restricted to being limited to some 401k lineup picked by some investment policy statement that's as generic as you can possibly imagine, which is just meant to protect plan fiduciaries so they don't get sued at some point down the road. The self-directed brokerage option is not advertised through employers because for them it's potentially a risk if an employee who doesn't have the financial wherewithal to make the investment decisions, they take that money and they don't do very well with it, they potentially could come back and sue the plan and the plan fiduciary. But we advise our clients, like we want to know if that option's available, because we can either plug in our managed accounts depending on the platform that they work with, where it's automatically managed for them, or we help them construct a model that we review on a quarterly, semi-quarterly, or semi-annual basis, where we say, okay, are there changes that we need to make? Either way, we're trying to get away from this limited construct that 401ks are sold and serviced on, because in its current construction, the probability of successfully retiring off 401k and funding your retirement is slim to none. And so that's first and foremost. Is there a self-directed brokerage account window? Are you working with someone that can help you manage it, or do you have someone that can manage it for you? Awesome. That would be our first recommendation when figuring out what investments to look at for a 401k. The second part of it is, okay, let's say that you don't have the financial expertise and wherewithal to do this on your own, and you don't work with someone, and you're just going to be working with the investment lineup that your plan offers, and you're just trying to figure out how much money to put into what investment. And that's where we want to go into a real life sample, because one of our newer clients came to us and unfortunately does not have access to the self-directed brokerage option. So we just say, okay, let's just take a look at what's available in your 401k and try to build you the the best, if you will, the best lineup that we can based on what your plan has to offer. So here's a sample statement that this person came to us and said, okay, here's what I've done so far. Are there ways to improve on it? The first page of a statement is pretty bland and ordinary, but from our perspective, we're going to take a look at the investment type and the current allocation that somebody is in, right? So I see here that we have no money going into income. Some money, or 100% of the investments, are going into a blend of growth and income. So, right, your general assumptions are, if it's in income, it's in cash and bonds and fixed income strategies. The assumption was, until these past couple of years, that that bucket would earn you 4 to 5% year over year in return, and that it was a less risky investment. Now, growth and aggressive growth are obviously focused on earning returns above the 4 to 5 threshold. And our assumptions with people are, these buckets, growth may be anywhere from 7 to 12% year over year. And aggressive growth, you're just trying to shoot the moon. Some years you can hit it pretty well and maybe do 20, 30, 40%. Other years, if it market goes in the investments go in another direction, you're going to be going 20, 30, 40% in the other direction. But over a longer period of time, especially if you have 25, 35, 45, 55 years that you're saving and let's say investing into these things, over that period of time, you're going to be averaging out higher annual returns than what you would in growth. So probably you're looking from anywhere from 12 to 20% average year over year, if you can. And then you have to match that with the investor's risk tolerance, right? So most people are not able to handle aggressive growth based on their personal appetites for loss and gain. It could also be just risk and time horizon. The assumption in the financial planning world is, the older you get, the less risky you should be. There are some caveats to that, because one of the biggest things that we're seeing with current retirees who are retiring with pensions, investment accounts, and 401ks is they did not carry enough risk to build themselves enough investment assets in order to sustain their retirement. So we'll talk about that one in a little bit as it pertains to target date funds. Where we want to look at is going to be page 2. So obviously when we're looking at, okay, we want to build an allocation and a model for our client moving forward, let's take a look at all the investments that are available, right? And so here's the complete investment lineup. You have 1, 2, 3 fixed income, which are plain vanilla. Stable value fund it's an insurance product which operates almost like a money market fund, but you have to be careful with these because they can lock up during downturns and not be liquid. A lot of people ran into that problem in the 2008, 2009 crash. The blend of growth and income, and this is where we could see our client has access to Fidelity Freedom target date funds. So we are going to look at that. The others they have access to are 1, 2, 3, 4 growth funds. It looks like, let's see, Windsor, that's a domestic S&P 500 index fund, US growth, and a mid-cap index fund. These are all basic domestic investments. here in the United States. When we look at that, all of a sudden it stands out. From a diversification standpoint, you have to think about diversification both inside and outside the United States. And right off the bat, we don't have a lot of options for fixed income. And now we really don't have a lot of options for diversification in our growth bucket, especially when you're playing the domestic and non-domestic game, which is very important. Under the aggressive growth category, okay, so here we go. Small cap index fund, small cap companies, mostly probably in the United States, and a couple international funds. So there we can have access to some non-United States and non-domestic investments. So we're a little bit happier with that. But when you look at this entire lineup, there's no access to alternative investments, no real estate, no commodities. There's not any hedge fund options. This entire 401k is 100% at risk to the United States dollar and the US markets. And it doesn't matter if it's fixed income versus equities. There's not a lot of opportunity for diversification here. So when we're looking at it, and case in point is probably that little rate of return down there. In this case, our option is we're going to try to find the best Fidelity Freedom target date fund and try to make sure that that's a good fit for our client. Let's talk about the target date funds. So we're going to use Fidelity, for example, and we'll pick on them a little bit. So when I was at BlackRock, I worked with the group that invented target date funds. If you look at institutional target date funds, BlackRock and Vanguard are the two number one and number two providers for target date funds. And I would say primarily it's first and foremost, it's because they're index funds and they're passive, lower cost, not actively managed. And the second part of that is the diversification in the portfolio makeup and the thinking capital behind it. But as you're going to see, there's still a lot of debates over target date funds and if these things actually work. In today's market, in today's time, there has never been any individual in the United States that has invested money in their 401k, invested it into a target date fund, and then successfully retired off of that strategy and outlived their money. It's never happened. A problem with that, it's twofold, right? It's one, these things are kind of plain vanilla. Don't say kind of, they're plain Jane, right? They're built as a massive capture-all. Every company has a different glide path. So a glide path means it's just a roll down of risk over time. So as you grow older as an investor, the model automatically de-risks and gets less risky over time. But here's the issue of it is if you look at the biggest issue that people have in retirement today is they weren't risky enough with their money, and their earnings on their investments and savings are not enough to carry them over time with the decrease in purchasing power, cost of living, everything that you have to deal with in retirement. So I think there are a lot of pain points that people are going to start experiencing when they retire with 401ks. And we're starting to see the first group go through that right now. So it'll be a very interesting thing to see how, the 401ks adapt and change over time. So anyways, I'm looking at, okay, for my client, let's say that, she's going to retire in the year 2050. First thing I'm doing with a target date fund is I want to see their glide path. So all I did is, let me switch over to this, is I put into my Google Fidelity target date fund glide path. And there's how freedom funds work target date strategies. I go right on here, and this is what I'm paying attention to. All right, so I know that 54% is going to be invested in US equities, 36% is invested in non-US equities, 10% is invested in bonds. Great. So that means, 90% of my money is in equities. I'm okay with that as a 25-year-old. 50-year-old, see how the risk adjusts down. So 47 to 32. So now 79% of my money at the age of 50, let's say 80%, might as well just be 80-20. 80% is still in equities. Okay, we kind of like that risk profile. When you get to 60, here's where the rubber hits the road. This number is more 47-43, or sorry, 57-43. So that means 57% of my 401k is invested in equities, 43% is invested in bonds, and then my roll down at the age of 75 years old is I have 62% of my money is in bonds. 38%. If you look up top, that's short-term debt. So 68% is in fixed income, 32% is in equity exposure, both US and non-US. So the issue that we have here, and this is research that we did back in the early 2010s, mid 2010s at BlackRock, a person must have, and this was at this point in time, 15 years ago, before everything that's changed financially in our world has happened. The assumption was you had to have at least 39% of your money in equities across the entire retirement spectrum in order to make it and have your money outlast you. And the probability that that would happen was, let's say, 97+%. So it doesn't matter if you're 60 or 85, you still have to have a 40% exposure to the equity markets. At the age of 75, this is a huge drop off, right? Now take a 75-year-old last year that had a 401k and their bond allocation dropped just as much as their equity allocation. So that means that their entire strategy at the age of 75 would have dropped 20%.
That's a lot.
Right. But this is what the 401ks are setting people up for. Furthermore, it's like, okay, how do you do your research on stuff like this, right? So if you go back to, let me just go back to, all right, so let's take a look at our investment lineup, and I'll look at the Fidelity 500 Index Fund. Here's exactly what, I would do. So I go into my Yahoo Finance. I'm using this as an example just because it's what retail has access to. There it is, the Fidelity 500 Index Fund. Here's what I want to look at. I always set the max for performance and value over time. So you can see since July 1, 2011 until today, the fund is done pretty well in terms of performance. I expect that, especially after the money printing that we've done since 2008, it mirrors the S&P 500. Let's see, go to the chart. Same deal. So with an index fund, I just want to make sure that this thing is acting and behaving like the index that I'm buying with my equity. So this is meant to track your top 500 financial companies that are listed on the S&P in the United States. And we can see that it's basically tracked it to the T, since its launch in 2011. From there, historical data, I don't really pay attention to. From time to time, I do. Profile, I like to look at. So, management information, who's the portfolio manager. At the end of the day, this is not an actively managed strategy, so it's more computer run. I like to look at style box. If you haven't seen this before, this investment is an equity, and then they break it down to, is it a value? Is it a blend? Is it a growth? This one is a blend. Is it large or small, medium, large, medium, small? So this means that this investment strategy invests in large companies, and the performance should be a little bit of growth and a little bit of value, which are dividend paying, and So it's not as volatile as a straight growth, but not as slow and steady and tortoise-like as a value fund can be. I always like to look at holdings. I can see that, okay, 99.33% of this is in stocks, the rest is in cash. I like to pay attention to where things are being invested from sector perspective. Cyclical, financial services, very little real estate, no basic materials, which in today's times are probably good exposure to have. Some healthcare, very little utilities, communication, very little energy, and some industrial and technology. So from my perspective, I'm like, okay, it is what it is. It's an index fund. And I just wanted to make sure that that's going to do what I wanted to do. Now let's take a look at a bond market fund that was available in that Vanguard Total Bond Market Index. Bonds are meant to be slowly appreciating over time. As you can see in this bond fund, its value is exactly the same as it was in May of 2007. So in terms of the overall value of this, it hasn't necessarily grown. So that means your return is going to come from your bond yield. So the yield is about 2.51% year over year. Same thing, this one's, you can go into the profile, see who, see the Morningstar style box, see the strategy, managed by Vanguard, all that other fun stuff. Options, if it has options available, if they use options, you'll be able to see the calls and puts if you're interested in that. And then again, I like to look at the holdings on these strategies. So I can see that most of this is invested in no government bonds, but high quality AAA rated, AA rated, single A and triple B. So this is all high quality bonds that are meant to produce annual income. So that's a de-risking part of it. If you look at the bond side of it, and you can do that if you have a greater investment lineup, you can do your research, figure out what sits well with you, and then figure out how much and what percentage of your money you want to go into each strategy. If you're going to look at the target date funds, because that's your only option, now you can see, like even year to date, this fund is down 18%. Since July 1st, 2011, it's had some ups, but it's had some downs. For the target date funds, we already took a look at the glide path, so we know how this is going to behave. My 5-year average is really what I'm looking for. So if I'm going to make an assumption about how this strategy is going to do over time, I'm always I like to look at a 10-year average, because there are investment strategies out there that have that type of track record. And I like to see how they do every 10 years, because the number in my mind is I know that every investment I have has to earn 10% a year over year, just to keep its value with how currency is devalued over time. Because we know here in the United States, our currency value and purchasing power drops 10% year over year, or 100% each 10 years. And looking at that, I'm like, okay, you could stretch this out and say, let's say it's a 10-year average of 7.62%. In my head, this strategy is still almost 3% behind what it needs to do in order for me to have that purchasing power at retirement coming out of my 401k. The other thing is, you can look at the holdings on the target date funds. This one's a little different than the S&P 500, obviously. It has some more exposure to bonds and preferred stocks, convertible stock, bonds, all that stuff, but pretty much the same allocation as the S&P 500. When I look at something like this as a target date, unfortunately, this is the best option that this individual has. So you have to work with the card you're dealt. But at the same time, there are options to try to figure out, okay, do I have a self-directed brokerage account? That's looking at the investment lineup. It's not jazzy at all. And whenever you're selecting a target date fund, I usually share with people, my recommendation is, okay, pick the year your target retirement is at the age of 67, 70, whatever. In this case, our target retirement year was 2050. I take the fund that's the next one out at 2055. just to give me a little bit more equity exposure over that period of time. I never want to be taking on too little risk, because over time that's going to create a lot more risk to the portfolio and to the probability of having a successful 401k plan. This is the other reason why it really drives me nuts with 401ks. Some of the plan's administrative expenses were paid from the total annual operating expenses of one or more of the plan design investment alternatives through revenue sharing, 12B1s, and sub-transfer agent fees. What this means is all the fees that you're paying on your 401k are already built into your investments. Don't think that Vanguard doesn't have revenue sharing either. They pay a lot of companies to get on their platforms, and people pay them a lot of money to get on their platform. So you just don't see it behind the scenes. And then plan administration fees, those come out of the plan as well. So you'll see the difference in really what the true cost of your 401k plan is. If you go out, and this isn't set in stone, it's 100%, but you'll get a pretty good idea. If you take an investment and you say, okay, what is the performance of that investment over the past year, and then compare it to the return published on your 401k login and account, you will see a difference there in return, even though it's the same time period. And that will give you a pretty good idea. And that's a good starting point to figure out, okay, how much might I be paying for this 401k? Another one to keep an eye on is, these are going to become very interesting. Lifetime income illustrations. I share with people, don't even pay attention to these things, because their assumptions are so generic and not taking into account so many different factors that they cannot be relied upon. From a marketing perspective, when these 401k platforms are developing this tool, it's really meant to get you to put more money into your 401k. Because why do they want that? Well, because they're making money off of your money. It's very interesting to see how different platforms are using technology and this, hey, here's your lifetime income off of your 401k assumption, in order to get people generating and putting in more money, right? It would say, hey, based off of today, your annuities, let's say $1,000 a month, but hey, if you put in 1% more, it's going to be $1,200 a month or $1,500, depending on the time frame and assumption. So I would just warn people to be on the lookout for that. And that's it. I mean, these 401ks are quite frankly boring. The investments are boring, and they can be boring just because of the way they're structured, bought and sold. If you're out there building your own lineup, do your research as much as possible. If you're using target date funds, at least understand how these are going to be managed, or at least the risk allocations are going to change with that glide path. And then just make the determination of, do I want to have the model built for me and run for me, or do I want to build it on my own, or can I work with someone to help build it? So yeah, that's it. 401ks, like I said, they can be boring. Their investment lineups are across the board pretty plain vanilla. I just think they're missing a lot of exposures and opportunities, but that is really the way that they're structured and bought and sold and managed in the country. So you're just trying to deal with the cards and play the cards you're dealt with, or play the cards you're dealt, and making the best out of whatever situation you have. But the success of a 401k in supporting retirement is dependent 100% on putting as much as humanly possible in there and hoping you make it at the end of the rainbow, and you might as well walk to a roulette table. You're playing a casino game.
So I think that's all we have for the second part. Please be on the lookout for part 3. It should be coming out in the next week or so. Thank you everybody for tuning in. And if you like it, please share, subscribe, comment down below any questions you may have about 401ks or any other financial topic. Tim, any last words?
No, 401ks are a big deal, and don't go on it on your own, because I can tell you from being on the inside of these things for a long time, they're they're not meant to be successful retirement accounts. And I think a lot of people are finding out that these things are not cracked up to what they should be. And so you have to figure out a way to tilt the game in your favor.